All right, let's dive right into this. Welcome to the boardroom for today's Explainer, where we're going to rigorously evaluate Worthington Steel. Now, we aren't just skimming a standard earnings report here. No way. We're putting this company through the absolute ultimate gauntlet of legendary investment frameworks. We're talking Buffett, Lynch, Graham, and some hard-hitting quantitative modeling.
Here is the game plan for today. We're kicking things off with a company snapshot, and then we're going to test the stock against the distinct philosophies of Warren Buffett, Peter Lynch, and Benjamin Graham. Finally, we'll run it through our alternative models and deliver our final verdict. So, starting off with Section 1, the Worthington Steel Company's snapshot, let's get a solid baseline on the asset we're actually evaluating today.
Currently trading at $39.76, Worthington Steel, ticker WS, is a massive player in the value-added metals processing space. And to be clear, this isn't just some old-school company pouring hot metal. They are highly specialized. They're actually the #1 independent flat-rolled service center in Mexico, and crucially, the #2 manufacturer of electrical steel laminations globally. That specific capability makes them a huge, kind of hidden driver behind the entire electric vehicle transition. But beyond the financials, there's a really fascinating golden rule culture here. Led by CEO Jeff Gilmore, they boast a world-class safety record, pulling their total recordable incident rate down to just 1.51. Combine that with a 98% waste diversion rate, and you're looking at something that isn't just good PR, it represents extreme operational efficiency and minimized regulatory risk. They brand themselves as strong for good. But the real question for us is it a strong investment? To answer that, let's move to Section 2, the Warren Buffett lens. Time to see what the Oracle of Omaha would think. We all know Buffett's style, right? He's hunting for high-quality businesses at fair prices. He demands a distinct economic moat, really excellent honest management, highly consistent earnings, and absolutely a definitive margin of safety before he even considers making a move. When we evaluate Worthington against his strict criteria, they actually hold up really well. They've got a solid return on equity that fluctuates between roughly 10 and 15%. Their debt is totally manageable, sitting at about $224.3 million compared to $90 million in cash. And as we just discussed, management is superb. Now, the economic moat is what we'd categorize as narrow. Their tech capabilities in EV laminations are stellar, for sure, but they are still ultimately tethered to highly cyclical global steel pricing. Even so, it passes the fundamental quality test. If we calculate an approximation for Buffett's beloved owner earnings, Worthington is generating roughly $96.2 million annualized. Buffett would deeply respect that kind of cash generation. However, to protect against that steel market cyclicality and the added leverage from their pending Klöckner acquisition, he would absolutely demand a strict 30% margin of safety. That pulls his target buy price down significantly to right around $25 a share. Let's shift gears to Section 3, the Peter Lynch lens. Let's see how he would categorize and play this stock. Lynch treats cyclical companies completely differently than other stocks. He famously advises that you actually want to buy cyclicals when earnings look terrible and the PE ratio is artificially high. Then you sell them when earnings peak and the PE drops, which makes them look deceptively cheap to the untrained eye. The crucial first step here is categorizing Worthington correctly, and it is highly cyclical. Roughly 30% of their pro forma revenue is exposed to the automotive sector, and another 20% to construction. Looking at their PEG ratio, price to earnings divided by growth, it sits at a pretty unfavorable 2.29. Also, Lynch constantly warns against diversification, expanding just for the sake of expanding. Worthington's massive bid to acquire European processor Klöckner definitely triggers some of those exact warning signs, even though their balance sheet is currently looking very strong, with a current ratio of 1.66. Because we appear to be sitting somewhere mid-cycle right now, combined with softening European markets and that high PEG ratio, Lynch's verdict would be a firm hold. He'd tell us to just sit on our hands and wait until the cycle truly bottoms out. Okay, Section 4, the Benjamin Graham lens. We're going to strip away all the qualitative stuff now. No management culture, no future EV promises, just cold, hard numbers. For Graham, the undisputed father of value investing, the game is purely about a defensive checklist and buying assets for significantly less than their mathematical intrinsic value. Absolutely no exceptions. When we run Worthington through Graham's rigorous defensive checklist, it actually puts up a great fight. Adequate size with over $2.5 billion in year-to-date sales? Check. Financial condition with a current ratio safely above his 1.5 requirement? Safe.
A consistent dividend record of 64 cents trailing? Yes. But they stumble hard on valuation multiples. Graham demands a PE under 15 to mathematically limit downside risk. Worthington is hovering near 23.
Crunching Graham's classic intrinsic value formula, taking the square root of 22.5, multiplied by their $1.73 EPS, and then multiplied by their $24.17 book value, gives us a hard mathematical value of exactly $30.67. With the stock currently trading near $40, Graham wouldn't touch it right now.
All right, with the legacy gurus out of the way, let's move to Section 5. It's time to crunch some modern quantitative models, discounted cash flow, and comparative metrics. Let's dive into the DCF. We're assuming a base free cash flow of roughly $96 million. Factoring in the cyclical nature of the business, mixed with the growth kicker of those EV laminations, we modeled a 5% growth rate and applied a conservative 10% weighted average cost of capital. That brings our base case fair value to $24.01. Honestly, even stretching our model to its most optimistic boundaries, an 8% WAC and 3% terminal growth, only gets us to $33, which is still well below today's trading price. Now, if we look at alternative models, we see a massive divergence depending on the methodology used. A dividend discount model, which heavily penalizes their relatively low yield compared to required returns, points to a highly pessimistic $13.44. But conversely, if we apply an optimistic comparable peer multiple analysis, matching some of the higher-flying specialty steel processors with a PE around 30, we get an implied value north of $51. Which brings us to Section 6, Synthesis and Final Verdict. It's time to bring all these frameworks together and make sense of the noise. Synthesizing these drastically different valuations reveals the absolute crux of the issue. At $39.76, Worthington Steel is trading at a distinct premium. Literally only an optimistic peer comparison justifies this price tag. Graham's math, the DCF cash flows, and Buffett's safety margins are all screaming that the stock is fully priced right now, if not slightly overvalued. Make no mistake, there are tremendous strengths here. We've got a fortress balance sheet, phenomenal positioning in the EV electrical steel market, and a top-tier management and safety culture. But you have to weigh that against the cyclical auto risks, the impending leverage needed to integrate Klöckner, and the current pricing premium. That leads us to a definitive hold recommendation today. This is a wonderfully managed, high-quality company. They are physically manufacturing the products that are driving our sustainable future, and we absolutely love the business itself. But as all the legendary gurus teach us, a great company and a great stock are two completely different things. Even the best business in the world must be bought at a safe price. We'll leave you with this final thought. Worthington Steel's motto is that they are strong for good, and they've definitely proven that operationally. But as an investor, do you have the discipline to wait for the market to present that necessary margin of safety? Keep that in mind, stay focused, keep learning, and we'll see you in the next explainer.